Welcome to the daily update, where I'll go over the action in the market for Monday, May 19th, and we'll see how things look for Tuesday, May 20th. You've got a really resilient market right now, having a difficult time going lower, and there's a lot of optimism. There's a lot of FOMO, fear of missing out. So you've got a lot of people coming in. Anything that they perceive as some kind of a decline, they're buying that. And so you've got a market that's holding up quite well. Now we're still overbought. We do have a confirmed trend now. We were able to cross above 20, both with the short-term ADX and the intermediate-term ADX. That means we're now in a confirmed trend that's positive. And we're positive in the short, intermediate, and long term because we're above all those moving averages for those time frames, but we're looking overextended. Now, there was some news that came out after Friday's close that Moody's had downgraded the U.S. debt because of so much debt, and that produced the lower open. The futures gapped Sunday evening to the downside, and we were down, but folks started to come in and do some buying as the day unfolded. Okay, so right at the open, we had a gap lower open below 5,900, setting the intraday low. That was right where we set the low for the day. And then prices climbed above S1 at 59.24, but it hit resistance at the daily pivot at 59.41. Then we finally were able to break above the daily pivot and the unchanged level. That's when we actually went into positive territory. But we hit some resistance before falling back below the unchanged level. But yet again, prices chopped sideways below the unchanged level, but there was some late day buying that came in. Brought prices back up to close slightly positive, virtually unchanged. But again, as I say, it goes in the books as an up day. We were up 0.09% on below average volume, and we are positive in the short, intermediate, and long term because we're above the 20, 50, and 200-day moving averages, but we're looking quite overextended, and I'll show that to you as I go through the charts here. Interest rates really shot up, and that was a concern right at the open, but then they ended up dropping, and we're back under that 4.5% level with the 10-year yield. And it has a lot to do with the tariffs and what's coming out of Washington, D.C., and the optimism now, where you project back a month and a half ago, everything was pessimistic. Now it's more optimistic. Excuse me, more optimistic. All right, so some comments. Moody's did downgrade the U.S. credit rating. This happened on Friday, right after the close. That's kind of interesting. And there was initial negative reaction, no doubt about that, but the market just kind of shrugged it off. There's also the possibility over the weekend that Congress may pass a large reconciliation bill. It's come through another hurdle through that whole process, and the market would like that. On a short-term basis, a few things came off the list, but our list is still pretty long. And as I usually point out here, when we're in an uptrend or a downtrend, the things that are on this list are always on this list, like the StochRSI, Williams percent R, CCI 1420, Stochastics. Those are the usual ones. The ones that kind of come and go off the short-term list would be the 20-period exponential moving average of the S&P. The rate of change, the 5-period has fallen off, but now we have the 10-period that's coming on this list and the 20-period, just meaning we've gone up pretty fast. The boom indicator, we're still far away from the 20-period moving average. We're still extreme, but we're starting to roll over with the slope oscillator. The short-term RSI is still extreme, and then the 20-period moving average steady. In the intermediate term, we're also far away from the 50-period exponential moving average. We're getting extreme with that reading on the S&P. The CMB composite, that's been on here for a few days. We're up in the +3 channel with the standard deviations chart. The McClellan oscillator for the S&P. The PMO itself is looking extreme, as well as some of the studies that go with that. The MACD is still extreme, the TTM squeeze, although it's turning a little bit more negative. And we have the bullish percent indexes for the S&P and NASDAQ 100. We're far away from the 50-period moving average as measured by the boom indicator, and the ultimate oscillator is extreme positive. No changes to the overall scenario for right now. as it applies to the Fed. It's pretty much all coming out of Washington, D.C. now, or Trump. You could say that, whether he's in the Middle East or what have you. The dollar was down. It was down pretty heavy with that Moody's downgrading, but it was able to claw its way back a little bit there. And interest rates ended up being up here. This is a mistake. Interest rates were up. We're at 4.47%. We were above 4.5%, but by the time the bond market closed, we were back below that 4.5% level. Where after Friday, they were at 4.44% for the 10-year yield. Sentiment ticked down one notch, and we're still we get a little nervous. The closer we get to 75, that starts to show that possibly the market's too extremely positive at that point, but we're still coming in at 70, where we had been at 71 after Friday. We now have a confirmed trend because the ADX has crossed above 20 and we're above the moving average. The green line is above the red line. With the up day as minuscule as it was, we're positive with the bias. That's usually the bias is up day, down day, usually. And momentum is positive the last number of days taken together. Okay, we only had the leading economic index or indicator that came out, and it was weaker than expected. It was down 1%, where they expected it to be down 0.7%. Last time it was down 0.8%. And here I have a chart of that, a couple of charts. The black line, this is the leading economic index right here. And it fell for the fifth consecutive month that we're seeing. And actually, it's the blue line that's coming down here. The coincident line is the black line. And this is more applicable to things happening right now. What we're getting a little bit concerned about is that we're coming down with the 6 month growth rate. If we fall below this red line, that is a recession signal. So right now we're in warning territory. If we see more of a drop with this indicator, we'll actually get a recession signal itself. Now we did get one back in 2022, but we never went into a recession after that. And then the line was able to turn and come back up. So there's a little bit of concern over this chart as well. All right, then looking at real investment advice they posted at Isabel Net blog charts. This is trying to make a correlation between the 2020 correction and what's happening in 2025. And there's a bit of a connection here between the two. I just use these as something interesting. Some people make their decisions based on charts like this. I don't do that. We just use this as kind of a guide where we started off looking a little bit better and then we had our real decline back in 2020. This was, of course, the whole COVID crash, and then we bounced up out of that. We're seeing some similar patterns here. They have a couple of areas circled where we might run into some problems, but for the most part, if we stay on the same basic course, it looks pretty positive going forward. And then we look at from a technical score perspective. That's what the black line was the different technical scores back in 2020 and where we've seen them line up so far in 2025. And it looks pretty positive going through about the end of the summer before we might see a little bit of problems later on. And then to try to compare what was happening back in 2020 versus what is happening now, the economy was in a recession at that time, but we V-bounced up out with the stock market. We also, with all the stimulus that was just massively being thrown into the U.S. economy, we didn't stay there for very long. We're just seeing slower growth in 2025. Interest rates were falling then. They're more stable now. That was about a month ago when interest rates really came down, then they shot back up. They're going a little bit higher now, so that's a little bit of a concern. We're watching that 4.5% level with the 10-year yield, but they are more stable than what we saw back in 2020. Inflation was falling during that time and it appears to be stabilizing right now. The interest rates at that point, the Fed fund rate was at 0. We're at 4.3%. We're in that range between 4.25% to 4.5%. And the monetary policy, they were doing QE. That's quantitative easing. That's where they come in and they're buying bonds, adding liquidity through the bond market. And then a lot of that comes over into the stock market, where now they're doing QT, quantitative tapering, where they're actually pulling money out. And as they announced before, it's at $5 billion a month. It had been a lot higher than that. They're actually decreasing the amount that they're taking out. And then as far as what the government was doing at that time, massive stimulus, the stimulus checks and the rounds of all of that that happened where there's no stimulus going on now. Just to kind of compare the two with each other. And then right after the tariffs were announced, we saw just a huge drop off in China to US shipments. And this is not necessarily surprising here. And then rate cuts, they continue to disappear. Now, this changes all the time, but it says no cut is priced in until September 17th. And even that, which is in blue down here at the bottom, even that is disappearing. It was more than 100% about 10 days ago. Now it's dropped down to 66%. But this will change as things work their way out. And then this one from Carson says, no, this isn't just another bear market rally. And we can see where we're bouncing back up right now. Well, how do things look after we're up greater than 19% in 27 trading days? And it looks pretty good here. Going back to 1950, we're up about 60% of the time a month later, 80%, 80%, and then a year out, 100% of the time. When you compare that to all the years, not just a post-election year. Valuations, this chart seems to come up periodically here. We're still seeing the NASDAQ 100, the most expensive. We use that 10, 15, 20 scale, and we're above 20 right now. So the NASDAQ 100 is considered to be expensive. This is the small caps, which I disagree when I see this. There's another chart that I go over in the intermarket analysis video and has this down around 14, 15 or so for the small caps. But that's the S&P 600 small cap. This is the Russell 2000. But you'd think they'd be more in line with each other. Or the S&P is getting a little bit more expensive. As we've been going up, we're getting further above that 20 level. And then the equal weight is more fairly priced, where the mid caps are also more fairly priced. Then the commodity trading advisors' exposure to gold, they're actually starting to pull out, even though they are still positive. The gap between the Magnificent Seven and then the rest of the S&P 500 earnings is expected to narrow here. That could also change. We get into some good times or bad times, and these numbers will really adjust. And then discretionary investors, this is opposed. The other way of doing this would be systematic, where you just follow a system. You don't care what the market's doing. You don't care if it's going up or down. You just follow a system. Where discretionary, it's like, okay, we pay attention to what's going on in the market. We might get out of the market when things are difficult and then get back in when things are looking better. And we've seen a real bounce up back above this zero level here, showing that discretionary investors are seeing, they appear to be more optimistic right now. And then performance of companies beating and missing their earnings per share estimates, not really all that great. If they beat it, doing okay. If they miss it, they tend to get hammered more than other stocks do. And this is just for informational purposes here. It's, all the different things have been hitting the market going back about a year, well, not quite a year, back to September, where the tariff talk, the FOMC is meeting, we had the election, you've got bank earnings, Walmart reports that ended up not being very good. At least right after that was when things started to fall off. And then how the tariffs have been impacting things. And then now how things seem to be improving, where the news doesn't seem to be quite as bad as it was before. And then government debt, the CBO, they're the ones who make projections. They're arguably too optimistic because they assume lower interest rates than what the market is expecting. And then using market rates, the GDP will double to 6%. Excuse me, the debt ratio will double to 6% of GDP over the next 10 years. That's why Moody's downgrade matters. Okay, it's just what this chart is saying, what they think will happen compared to what has been announced as what should happen going forward. And then retail traders, they're just coming in. This is the buy the dip, folks. Something that I don't implement, but a lot of people do. They really started coming in. You can see a really, really high reading here. And then if you remember Netscape, that was the first browser. Now it kind of morphed into Mozilla. If any of you use that, and I use a number of different browsers. I use Chrome, I use Mozilla. My favorite one is probably called Opera. And of course, there's the old Internet Explorer, which is now Edge. But what's interesting here is they're tracking Chat GPT with Netscape. And there's kind of a connection here where we seem to be tracking along the way. And then a little bit longer term, they're also having a tendency to track here. It'd be interesting to see if this still plays out this way. And then earnings revisions. Now they've been going down, but they're still positive. But the revisions have been going down looking forward, but they're starting to improve here. And that's what's helping the market as well. All right, here's the intraday chart where we did gap lower below S1. We came pretty much down and even broke a little bit below the pivot point for Friday's session, but that was the low right there. And then we just spent the day coming back up. We got above S1. We hit some initial resistance at the pivot point. We broke above the pivot point, broke positive, fell back under the unchanged level, and then going into the close, we did see some late day buying that ended up taking prices positive. And we're not seeing much of a change in the initial overnight session here, but this just shows how we were down and then we just kind of clawed our way back, even though we were lower. But then when the cash session opened, that's where we're seeing most of the strength right now. People are using any kind of weakness to buy the dip, whether you agree or disagree with that. We're still looking good with this. The blue line is above the red line with the intraday S&P growth to value chart. And trailing off a little bit here, but the bigger context is that the S&P growth to value intraday chart is still going up. End of day where growth was up, but up less than value, where everything else ended up being negative. The mid caps got hit, as did the small caps, but mid cap growth was down less, as was small cap growth. So still looking a little bit better in the bigger picture with small cap growth to value and mid cap growth to value and looking a little better here. We're still in a downtrend with S&P growth to value, but we're above both of these moving averages. And came back down a little bit here, but we broke out of the rainbow with this growth to value measure as well. But it was down both in Friday and in Monday's session, but it has been improving. Large cap growth back above all the moving averages, still looking better here. Discretionary to staples fell back here, but it's still above the moving averages, although we're still in a downtrend. And momentum stocks against the S&P or the ETF for the S&P 500, the SPY, these still continue to do quite well. And even when we were coming down, we set a low in March, and then everything fell apart in April, but we set a higher low here. And since that time, the momentum stocks have really been showing a lot of improvement, and they're actually positive here. We are finally back above 20 with the ADX with the short term. We're above the blue line and we're above the moving average, and the green line is above the red line. So short term positive. Seeing that same thing here, just barely back above 20 now with the ADX. And so we're confirmed with a positive trend there. And we continue to be dropping off as far as volume. We're just going lower and lower. Friday was strange because it was options expiration, and we usually see a lot of volume because of that. It wasn't. It actually came down in Friday's session and was even lower in Monday's session. That's a little bit of a concern when we continue to go up on a decrease in volume. That shows a market that's tired, and that's a classic technical analysis negative divergence. You want to see volume confirming price just on the surface. Now, there's other charts that we've been looking at showing that volume is actually leading price and looking even stronger than price has been. So this is the weekly chart that we get it's a composite of sentiment indicators here coming in at 69.37, which is just about where we're at right now with the chart that we look at every day. This just comes out once a week. We turned up a little bit, but we're still below 20 with the VIX, so that's showing more stabilization there. And if you notice here, we almost got back up to the 20 level here with the bar chart, but then we spent the day coming back down with the VIX. We're still below the moving averages with the VIX of the VIX. Momentum is still down for the VIX. And we ticked up just a little bit here with this fear gauge, and we continue to go down with this other fear gauge. So a little bit of a contradiction there. Here's another sentiment indicator, a little longer term, where we had become very extremely pessimistic. We are improving, but we still haven't gone above the zero level, according to the Goldman Sachs sentiment indicator. Then we look at legal insider transactions coming down a little bit, which could actually be bullish here as the market's been going back up. And here's the insider buying ETF. It's been bouncing back up along with everything else. And the daily equity put call ratio chart did see it tick up a little bit, but we're getting a very extreme negative reading here with the 5-day chart. And this sometimes is where we see some kind of a shift. So we want to keep an eye on this one. And we're continuing to go down with the 10-day chart and still getting a very low reading with this particular indicator as well. But not much of a change here with the volatility risk premium, kind of going sideways right now below the band, showing no real pickup in looking at fear 30 days out with this chart. Still looking pretty good here. Now, after Friday, we set an all-time high with the advanced decline line based on price and volume. We were pretty much flat on Monday. And we're seeing a bit of a negative divergence here with the advancers decliners over 10 days. We're going up with the S&P, but we're seeing this making a lower high here. Not a real big deal. We just want to be aware of that because when this really starts to go back down, it doesn't necessarily mean a reversal. It just means that we might slow down. We were extreme with the short-term advanced decline ratio. That's the blue line. It ticked down. It's no longer extreme, but both the short-term and the intermediate term are positive since they're above zero. Still seeing general improvement here internally with the new highs minus the new lows. A lot more green, not much red. Starting to turn up with the 5-day and the 10-day moving average. The smart money indicator number one, we might be getting kind of far away from this moving average here, but we're positive and we're above an advancing moving average. The boom indicator is actually coming down just a little bit. It hasn't quite crossed below its moving average. And smart money indicator number two is positive. The histogram is going up. The red line is going up. We want to keep an eye on this. If this keeps going up, we might get to an extreme reading here. I don't have an actual level that's marked. We just kind of follow along with other times when we had an extreme positive readings there. We are extreme positive with the Chaikin oscillator. We're above the green line. And you can see other times when we got at or above this. Now, it didn't mean a reversal, but it might mean some kind of a slowdown in price action. We're positive, but we're declining with the green line here with the vortex, but it's still positive since the green line is above the red line. And we're seeing improvement here with the advanced decline lines and different ways we look at this. We're still setting a new all-time high with the cumulative advanced decline line based on price and volume for the S&P. And we're finally crossing back above zero. We're turning positive with the 50-day new highs, new lows study here for the S&P. That's showing improvement there. We're coming down a little bit with our advanced decline lines, but we're still above the moving averages. So they're still looking solid overall. And then we look at the NYSE cumulative advanced decline line. Tick down just a little bit, but just coming off of setting a new all-time high. Tick down here, set an all-time high after Friday. And a little bit of a tick down here with the other NYSE advanced decline line, but still looking pretty solid there. Then we break it out based on common stock, tick down a little bit based on price. Didn't set an all-time high here, but we did set an all-time high based on volume. This is a little bit what I'm talking about, where it seems to be volume is leading price, but we did tick down just a notch in Monday's session. We're getting extreme with those stocks that are above their 20-period moving average in the S&P. That just shows good short-term momentum. But when we get above 80%, we're at 89%. A lot of times that's about where we top out with this indicator. The 50-period moving average study is also improving, but we're not quite above the 80 level yet. We're at 79.4. We tick down a notch, but we're above 50 with the 100-period moving average study, ticking down, but still above 50 with the 200-period moving average study. And still looking pretty good. We finally seem to see more stabilization instead of all this crazy choppiness that was coming into the market. This is more of an uptrend. We're above both the 50 and 200-day moving averages, but we continue to really drop off with volume. We're extreme when we look at the 20-period exponential moving average of the S&P, just barely extreme. The line's at 80, we're at 80.2 here. We're positive with the 200-period moving average since we are above 50. And then our usual charts. The StochRSI is extreme positive, showing positive momentum. The Williams percent R is extreme. We're coming down, but still extreme with the CCI 14 and the CCI 20. We're extreme here with the short, intermediate, and long-term stochastics. This is a further subdivision of the short-term time frame. Coming down a little bit, but still positive with the force index. The condition of the short-term trend still looks good. Both the green line and the blue line continue to go up, even though we're dropping a bit below the green line. And that's the double exponential moving average here. And we're above the simple and exponential moving average based on 20 periods, with the blue line above the red line. And here's the rate of change going back 10 periods. We were extreme, started to work that off. Now we're starting to get extreme again. And then the 20 period rate of change. This is really high. If you go back, count 20 bars here, we were pretty much near the bottom here. So that's why we're getting an extreme reading there. And we're still up at the upper end of the +3 channel with the standard deviations chart. Balance of power above the midpoint and positive. Still going up with the short and somewhat intermediate term trends here. That's still looking positive. We're still extreme positive with the CMB composite, positive with the go, no go with the blue bars, positive with the highest high value. The midpoint's going up. We're up here at the blue line, and that continues to go up as well. We're positive with the Landry light, and we're also positive with the proper order trend measurement. We're starting to look a little more negative here. We were getting just this massively powerful extreme reading here with the TTM squeeze. It's starting to roll over a bit. In fact, it's turning to the darker shade of blue. And this is longer term. You can see higher than what we've seen on this chart. Could be seeing a little bit of weakness coming in from that. Standard deviation, we're above the moving average because we've been moving quickly here over the last 10 periods. We're still positive with the ease of movement, even though it's drifting just a little bit lower. And we're positive with the Arun indicator. The oscillator is above 0. And we're seeing a little bit of a negative divergence here. We've been going up with the S&P. We're setting a lower high here with the S&P McClellan oscillator, and it actually came down a little bit in Monday's session. But we're still, because we're above 0 with the McClellan oscillator, we continue to go up based on price. And now we're starting to go above this red line based on volume. This means that we're getting extreme, and this is more intermediate term. And also seeing a bit of a negative divergence here with the NYSE McClellan oscillator, going up with the S&P, and actually seeing some weakness here and not setting a higher high with this indicator. But we're still going up with the summation index for the NYSE based on price and volume. We're turning down. We're actually negative now with the Swindler Trading Oscillator based on price and volume. They're going lower, but we're getting extreme with the PMO. This is a momentum oscillator, but we are still going up based on price and volume. We're getting really extreme with the PMOs that are rising. We're extreme with the buy signals. We're improving here and coming up to this green line with the PMOs that are above 0. We're still neutral, though, with the Elder's Impulse system. When looking at the S&P, we're positive with the parabolic SAR, and we are positive with the weekly chart as well. Now we're starting to roll over with the slope oscillator. Now, some of this has to do with how it's calculated, but it ends up being more or less a self-fulfilling prophecy, because as this is shorter term, and so as this is being calculated, price has been coming up. And so this can't help but roll over because it's using higher values to calculate itself. And that's why it looks like it's showing some weakness. But a lot of folks see this and they make decisions around this and other indicators like this. So we are in danger of actually dropping below the moving average. But we're still going up with the MACD and possibly looking extreme. So we're rolling over after being extreme with the slope oscillator, starting to get extreme here with the TSI, the other short-term oscillator. We're extreme with the MACD, higher than what we've seen on this chart. The PMO continues to be extreme, coming up to previous high levels here. And then the PPO is also, it's higher than what we've seen on this chart. We're getting extreme positive with the tricks in the KST. We're coming above these lines here, and these are the longer term oscillators. Starting to roll over a bit with the Copic curve, but still positive. And this just shows how we're getting very, very high readings here with the Copic curve. Pretty much flat though with the Sean trend meter, but it's positive since we're in the green area. We're above 50 with the money flow, and we're extreme positive with the ultimate oscillator. We're above an advancing moving average with on-balance volume. We're extreme in the short term with the RSI, not quite breaking above that level here with the intermediate term RSI. The intermediate term trend, the red line is crossing above the blue line. That's showing strength in the intermediate term trend. We're above the simple and exponential moving averages based on 50 periods as well as the 100 period moving averages. And all of the moving averages together. We're above all the plotted lines here, but we are far away from the 20 period moving average and the 50 period moving average. That's what the boom indicator tries to measure. And we're actually turning back a little bit more positive with the bullish percent index. We saw it tick down last Thursday and a little bit more on Friday. It actually turned back up here for the S&P, but we're getting a very extreme reading above 70. And a little bit of a tick up with the NYSE bullish percent index and getting an 84 rating on a scale of 0 to 100 here. This is a very high reading for the NASDAQ 100 bullish percent index. And we were able to close out the week last week above this pivot point. So far, we're up just a little bit. If we really fall, this is still around the 55.75 level, and we're quite a ways away from that currently. And we're still looking pretty good with the trend, different ways that we measure trend, with the Heiken Ashi being positive. The Kigi chart is positive, the Renko chart is positive, and the three-line break is redrawn now and looking more positive. We're looking better here longer term. We're above this 250 level with the 150 and 200 period moving averages. This is a little bit of a concern. We were for quite a while at a full-on buy signal with the Zohar-Chak method. It dropped down to 8 and then it dropped down to 4 last week. It's just sitting there right now. This is long term. It doesn't change all that often. We're going to be keeping an eye on this. If we continue to go up, we would expect at some point for these readings to go back up as well. And so we are positive across the board with stocks, where bonds, commodities, and the dollar, they are all negative across the board. And we're still negative in the long term with the mid caps and small caps. We dropped back below the 200-day moving average with the small caps. And we saw more defensive areas do well in Monday's session, like healthcare, utilities, staples, where discretionary tech communication, they were either down or not up very much. So it wasn't a real pro-growth day. And we saw a lot of negative things happen right after the open. We did open below 5,900 for the S&P. We got back above that, but the NASDAQ was down below 19.2, 19.1, 19,000. Canada set another new all-time high. I think that's 3 days in a row. And then we had a BPI cross in the utility sector, which after it has been seeing some weakness, it crossed back above 50. And here's the market carpet, where Apple was down, but Microsoft was up. Nvidia was virtually unchanged. And we see Tesla was down, where Amazon was up just a little bit. We're not seeing any real leadership from the big stocks right now. That's why we didn't see the index change all that much. Google was up a little bit. Meta was virtually unchanged. Still, well, United Healthcare, after falling as much as it had, it was up a little bit in Monday's session. But awful lot of red over here in the energy sector. And the Dow, still above its 200-day moving average and still positive year to date. It was up 1/3%. So it's showing some improvement there. And we're neutral, though, with the diamonds when looking at the Elder's Impulse system, above both the moving averages with the NASDAQ, and we're still neutral with the NASDAQ with the Elder's Impulse system. NASDAQ 100, virtually unchanged, up 0.09% here after it had really been improving, and we continue to be neutral with the Elder's Impulse system for the Qs. Momentum for the NASDAQ 100 is still positive and starting to get kind of extreme here with this PPO reading. And we are still having a hard time with the small caps getting above this R1 resistance level. They were down over 0.5%. And still in between the 50-day moving average and the 200-day moving average with the Russell 2000 small caps, still getting a very high reading with the RSI, but the momentum continues to be positive. Neutral with the Elder's Impulse system for the small caps. Mid caps having a hard time staying above their 200-day moving average. They closed a little bit above it on Friday. Well, we were down 1/3%. Now we're just a little bit below the 200-day moving average. Still neutral with the Elder's Impulse system for the mid caps. Still looking better here with the Wilshire 5000. And this is encouraging. The fact that we opened, went down, and then closed pretty much at the high. That's better. It means we repaired a lot of damage that was done. Also looking better here with the total US stock ETF, another broad market measure. Financial sector, virtually unchanged, but still looking pretty solid. The FANG index, virtually unchanged. We're starting to see the 50-period moving average turning back up. We'll see if it's able to give us a golden cross here soon. Apple was down over 1%, still dealing with its 50-day moving average and still in a downtrend. Amazon's in a downtrend, coming back down to its 200-day moving average. Microsoft has been doing really well ever since it reported earnings, but it's still in a downtrend. But the shorter term moving average is starting to turn up and virtually unchanged with Meta and just really avoiding very slightly. Actually, I guess we're a little bit in a downtrend here. But if we can stay above both those lines, it might cross back over into an uptrend. And Google, not a lot of change here. Underneath the 200-day moving average, above the 50-period moving average. Nvidia, virtually unchanged, still above both moving averages. Tesla got hit 2.25%, but it's still above both of the moving averages. Netflix, another day, and was that a new all-time high? It was only up 0.01%, but it's either at or near an all-time high. And the relationship between US and world stocks is starting to get a little bit stronger with the short-term correlation and leveling out after it had been improving with the longer-term correlation. Oil still in the low 60s. The dollar still above 100. Now, you're going to see a plus sign here. That's because it trades 24/6, 24 hours a day, 6 days a week. They take Saturday off and a lot of Sunday. But we're still in a downtrend here with the dollar on the daily chart. And we're starting to really go up here. This is trueflation. This is not a government thing, but we're getting close to that 2% level now from what they're coming up with as far as inflation is concerned. And we were above this 4.5% level with the 10-year yield, but by the time we closed, we were back down below it. And we were below the 200-day moving average based on price, but we were able to get back above that by the time of the close. And taking a little bit of a hit here with our growth to value ratios, but still above advancing moving averages and seeing pretty much that same thing with the different indexes above advancing moving averages. So what's our outlook? We are still positive in the short, intermediate, and long term. We're not going to have any economic reports on Tuesday. And then anything geopolitical. Now there's wars going on, and there's ceasefires, and there's talks going on. What the market is really fixated on is what's happening as far as the trade wars and the tariffs. Is there going to be any more released about that? Then the big report for this week is probably going to be initial jobless claims on Thursday. So it's a pretty light week economically. There will be oil inventories coming out on Wednesday, but I don't really track that. I don't see where it's that big of a deal myself, unless it gets really crazy. Then looking at the Stock Traders Almanac for Tuesday, May 20th, we are now in the week after options expiration, where we tend to be up two-thirds of the time and down a third of the time, going back to 1980. But when you look at May 20th, it's negative across the board. We were negative for Monday, we're negative for Tuesday. We'll see if that comes into play. Then here is the post-election year tends to look a little bit better. We're still looking at some positive seasonality. So depending on how you crunch the numbers, you can come up with positive seasonality or go back to the previous chart and you have negative seasonality. Here are the pivot points, which have already been updated on the YouTube community tab. And so we're still looking to be in downtrends here with the growth to value and discretionary to staples longer term. But they have been improving and they're above the moving averages. So that could improve. The swing trending oscillator is now pointing down based on price and volume. And then over the weekend, I go through the special K chart. It is still negative, but it's turning up and showing some improvement there. Then our three smart money indicators are positive. We're positive with the NYSE and S&P McClellan oscillators, even though we're seeing a bit of a negative divergence with those charts, but we're still positive with the summation indexes as well. The bullish percent index is showing some improvement there after we were getting a little bit concerned about the S&P BPI. How's that for acronyms? The NASDAQ 100, very extreme positive there. Just improving, but not extreme with the NYSE bullish percent index. The parabolic SAR is positive on the daily side and weekly side. We're still extreme with the 20 period moving average study, but all of them are back above 50. So short, intermediate, and long term are turning back to positive. We're positive with the momentum oscillators, but possibly getting a little extreme. But we've been saying that now for a few days. The ease of movement is positive, the money flow is positive, the ultimate oscillator is positive, but getting extreme positive. The vortex is positive, even though the green line came down a little bit. Financial sector is positive, and we are positive with the momentum of the NASDAQ 100, but that could also be starting to get extreme. Okay, then the conclusion. We are positive in the short, intermediate, and long term. In the short term, we are overbought. There are some negative divergences there. We're seeing a little bit more of the negative divergences, though, in the intermediate term, but we're still positive there. We're positive in the long term, but we are still in a downtrend. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.